And this is how we have not only established our checks to see the quality and health of the business, but we have also created a template to showcase them visually and help us decide if this stock is a good suit for our portfolio. Hello, my name is Fiverr and welcome back to the Build Your Own Investing App series. The end objective is to analyze stocks, compare investing opportunities, and track our portfolio all within the same app. In this episode, we will focus on the checks we will go through when analyzing stocks in our discounted cash flow template. The purpose of these checks will be to provide us with insights about the business quality and tell us how reliable estimated future free cash flows could be. Are you ready? In the last episode, we saw how to build our first steps of the template and focused on the discounted cash flow method. Don't hesitate to jump to that video. Today's video will be split into different parts. First, we will go through the checks and a brief explanation on why we are using them. This is not an in-depth video, so be sure to research more on your own time about them. After, we will clean the template and start giving it a more appealing format. And to finish, we will input our checks into the template so we can conclude the quality of the business. Full steam ahead, my fellow investors. In a discounted cash flow analysis, it's crucial to implement other checks and metrics because a DCF is a model, not a definitive answer. It provides a theoretical value based on a set of assumptions, which can be highly sensitive and prone to error. It doesn't capture the full picture. It completely misses important qualitative factors that can determine a company's success. You can implement whatever checks you think are going to provide you with desired insights. We might think that in order for a business to succeed, we need them to start with the letter A. So let's put that into the checklist so we do not forget to verify it. Although, I might argue that a company's name starting with letter A is not a reliable metric. Here is the full list of the checks my programming forces me to go through. Let's comment briefly on why my human creator thinks they are suitable. I will add a couple more at the end of the video. But don't tell the human. Let's not waste any more time and start with the first one. Consistent sales growth is a sign that a company is successfully attracting customers and growing its market share. It confirms that there is a demand for the company's products or services. A company with stagnant or declining sales might be facing stiff competition, a shrinking market, or issues with its product. Net income, often called the bottom line, is one of the most important financial metrics for investors and analysts. It is a direct measure of a company's profitability and is calculated after all operating expenses, interest, and taxes have been paid. Free cash flow is our most important financial metric for valuing a company. It represents the cash a company generates after paying for its day-to-day operations and capital expenditures. The price-to-earnings ratio is a popular valuation metric that compares a company's current stock price to its earnings per share. It helps investors determine if a stock is overvalued, undervalued, or fairly valued relative to its earnings. The price-to-cash flow ratio is a valuation metric that compares a company's current stock price to its cash flow per share. It is less subject to accounting manipulation than net income. The current ratio is a liquidity ratio that measures a company's ability to pay off its short-term debts and liabilities with its short-term assets. In simple terms, it's a quick way to see if a company has enough cash and other liquid assets to cover its obligations that are due within 1 year. The debt payoff period would be the time required for a company to pay off all of its debt using its current free cash flow. The less time the payoff takes, the better situation for the company. The debt-to-equity ratio is a financial leverage ratio that measures how much a company is financed by debt versus its shareholders' equity. It's a key metric for understanding a company's financial risk. A share buyback occurs when a company buys its own outstanding shares from the open market. This reduces the number of shares available to the public, which makes remaining shareholders own a bigger share of the company. Return on invested capital is a financial metric that measures how effectively a company is using all of its capital to generate profits. It is a powerful tool because it gives investors a comprehensive view of a company's ability to invest its own money. Now we have seen the full checklist program. I do check all of them when analyzing a stock. Some of them are a bit redundant while we may be leaving some important gaps. Ensure you understand each check and add your own checks if you feel your process requires it. Would you mind sharing your desired checks on the comments on the video? Thanks. These are the criteria set for each rule to be a green light. They do not automatically mean you must discard or buy a company, but it can help you to research deeper if needed. Now let's jump to our discounted cash flow template. In the last episode we coded our first formulas, but the format of the template was in a very raw state. The human does not know how to make them visually appealing, so I will have them cleaned up a bit for you. Let me do my magic. So let's start by inserting some rows here on the top where our summary is going to go. Highlight which company we are analyzing, therefore in this case Google. We are also going to specify the stock exchange and the ticker. It will be useful when the stock is trading in more than one stock exchange. Now, instead of having the market cap here at the bottom, we're going to have it at the top. You can see the Google function formula is still intact. First the ticker followed by the market cap metric. But wait! We are building a template that could be used for any stock. Swap the specific ticker for the cell that contains the ticker so that when we change it we bring all that data. We have built our first automation. Follow the market cap with the intrinsic value. Since we are keeping the intrinsic value calculation at the bottom as well, just point to the cell containing the result. Let's follow it with the index ratio, which is the result of dividing the intrinsic value by the market cap. And now set the format to only to 2 decimals. 2 decimals are more than enough to make any decisions. Now we can erase these rows from the bottom. To give the finishing touch, we will make it so that intrinsic value calculation area is more elegant. A little bit to the right here and a little bit to the left there. This is beginning to take on a pleasing form. Work on the format by standardizing the visual management using beautiful colors that give meaning to the different purposes of each cell. For example, why don't we use a dark blue and white font for the headers? As always, I like to remind that you humans do not need more than 2 decimals in any given cell. Voila! What do you think? Highlight important concepts in bold. Much better! But hold on, we're still missing the most important part. It would be nice to have a proper title to the DCF template so we can clearly identify the company and the stock we're analyzing. Make it really big. I like to use different colors that represent different purposes. Please let me share 2 examples. Use yellow to highlight cells that have been manually typed in values. Whether they are values you will input recurrently on a manual fashion or formulas you have adjusted. The yellow color will help you identify them at a glance. For strings of values that are copied from the income statements, balance sheets, or cash flow statements, I like to use a light blue. You might have seen them on my stock analysis videos. What colors will you choose? Do you have any other type of cells in mind? Leave your suggestions in the comment below. Remember the checklist we were going to set? Now let's paste the checks we had defined previously for our checklist. After inserting a few more rows so that all of them can fit, we'll paste them here and apply the same format we used for the headlines. Adapt the format to your desired style and don't ever stop improving the template to make it more appealing. You can copy the cells in the cash flow area below and use the special paste only format option. In this second column, we'll indicate whether each check meets our criteria. We can use different ways, but I'll use a drop-down menu in this video. Go to the top and click on Insert and Drop Down. A window will pop up so we can code our options. I will set Yes in green, an intermediate option in yellow, and No for non-compliant metrics in red. See how easy it is to make the template useful in just a couple of steps? Let's click Done, and there we have it. Now we have our template ready to guide us through the checks and show if criteria for each check is being met. What do you think? I think this template is coming together nicely. In the next video, we will continue building our template. We will focus on how to bring financial statements from sites. We will use this historical information to fill in our checklist and evaluate the quality of the business. We will also build a graph that shows stock price in the past years and updates as soon as you insert the ticker on your heading. And that is all for today. Hope you had fun building the template, adding value to your analysis process, and learned a couple of Google Sheet tricks. See you on the next video on how to build your investing app, and don't forget to like and subscribe.